Sponsored by New Orleans Distillers, creators of fine spirits and liqueurs. Through dedication to science, art, and passion, blends of tradition and flavor emerge. For you, always locally crafted. New Orleans Distillers, classically Southern.
Tonight, the Supreme Court strikes down Roe v. Wade and returns it to the states to decide. President Biden wants to suspend the federal gasoline tax for 3 months, and all the major indexes ended positive this month. Are we finally at the bottom? We've got that and more tonight on this Friday, June the 24th, 2022. Hi, I'm Andre Laborde. Welcome to Wall Street Wrap-Up for this Friday, June the 24th, 2022. I hope your week went well. Well, today the Supreme Court released one of their final decisions for the year, and it was a big one. The Supreme Court overturned Roe v. Wade, upholding a Mississippi court case that was named Dobbs v. Jackson Women's Health Organization, which bans abortion after 15 weeks. And now it returns these decisions to all 50 states to decide the question of abortion. Now, this decision by the Supreme Court stopped the federal mandate to make it a states' rights decision. And also today, nationwide, the cost of a gallon of gas went down a couple of cents from last week when we were last together. According to AAA, the cost of a regular gallon of gas is now at $4.96, which is down 4 cents from 1 week ago, but still up 61% from 1 year ago. And the Biden administration is stating that under their watch, there's a record amount of oil produced in this country. And when stated, it makes it seem that under this administration, there is a record oil produced, period. But as you can see, this chart, it's word games they're playing. It makes the viewer think that there is now record production, but it's only record production since Joe Biden took office. Prior to his coming into office, we produced much more oil and refined much more oil to gasoline as well. The last refinery in the country was built in 1976, and it's doubtful due to the regulatory restrictions that there'll ever be another refinery built in the United States again. And the president is proposing withholding the federal gasoline tax of just over 18 cents per gallon for 3 months to help lower the cost at the pumps just in time for the November midterm elections. Also, coming up tonight, we're going to be talking about the retail sector of our economy. Are we headed into a recession? If so, how will this affect our retail businesses in both e-commerce and brick and mortar or the shopping malls? Tonight, we've got the senior analyst and managing director at Oppenheimer & Company, Brian Nagel. Unlike just 10 years ago, many retail businesses didn't have the infrastructure to be both e-commerce as well as retail outlets across the country. Well, Brian Nagel, senior analyst and managing director at Oppenheimer, he's going to be here to discuss what stocks may be good to hold in your portfolio and are heading into a recession. Are we? We'll find out. Brian is going to be with us in just a minute. But first, how did the markets do this week? Well, all the index ended the week in the green, and it was positive. It was a positive week for every index for the month of June. And the S&P had its best week since early May. This week, the Dow Jones ended at 31,503, which was up 5.4% for the week. And the S&P 500, they closed at 3,912, which was up just under 6.5% for the week. And the NASDAQ, they ended at 11,607, which was up just short of 7.5% for the week. Well, let's get to our guest this evening. Brian Nagel is the managing director and senior analyst at Oppenheimer & Company, and he's here with us tonight. Hi, Brian. Welcome to Wall Street Wrap-Up.
Thank you for having me.
The Consumer Price Index released their inflation numbers, and they were hotter than they thought. How do you think this is going to affect retail outlets?
Without a doubt, these inflationary pressures, I think they are beginning to have some impacts upon consumer spending. And to the extent that they persist, I think those impacts on consumer spending will become more pronounced. It does not seem at this point that inflation has had a dramatic impact upon demand. In other words, we haven't really seen signals of significant demand destruction. But again, given my knowledge of consumer spending and how things tend to track over time, a lot of this will depend upon how long these inflationary pressures persist, and then to what extent they continue to spread through the economy.
So need will always be there, food or other types of needs such as that. But the discretionary, that's so far so good. That's still there.
Yeah, and then look, I think that's a pretty good way to break it down. I mean, what happens though is needs can change over time as well. Okay, but like, look, what we're seeing right now, and some retailers have called this out. Some of the big, larger mass merchants. In my coverage universe, I don't necessarily cover Walmart, Target, but obviously I keep an eye on them for reads into the consumer. They've said that. I mean, those companies have said that they've seen this shift in their business where consumers are sort of prioritizing now higher priced needs-based products and then de-emphasizing more discretionary type products. So I guess, from that standpoint, we are seeing some signs of that. I don't think at this juncture, though, and again, it's very early, it's a very fluid environment. I don't think at this juncture that trend has really been pervasive.
The Wall Street Journal recently wrote that consumers are still spending, and I think they said something like at a rapid clip. And I was curious. I mean, I was just trying to read between the lines. I'm curious if is it because inflation is so that sales are larger because inflation is there, or are sales larger because they're buying more items?
Well, look, it's a little of both. I mean, these companies have strategically, selectively raised prices as their input costs have climbed, and so as a result of that, their sales are actually higher. That has become a sales driver. So, the dynamic you described there, I think, is happening at the company level. But I think also, behind all of this, and this is what's making this environment so difficult to really analyze correctly. But yes, these inflationary pressures are historically high. But you also have a very healthy consumer. Wage growth has been historically strong as well. So the consumer backdrop is very, very strong here and historically strong. And I think that's helping consumers sort of offset, if you will, these inflationary pressures. But going back to my prior comment, I think it's only a matter of time. There will be a point at which the consumer basically says no more, and starts to react much more negatively to these inflationary pressures.
Depending on what the Federal Reserve does, do you think that we are going into a recession? And if it does, how will that reflect upon the consumer and on retail?
If the economy were to drop into recession, okay, inevitably that would be bad for most retailers. Okay, look, there are chains that perform better in recessionary environments or in slower consumer spending environments. So I mentioned a lot to our clients, the auto parts retailers. Auto parts retailers are quite recession resistant. Whereas there are other companies, and within my coverage universe, like the athleisure names, the Nikes and Lululemons, which again, if the economy were to move into a recession, they would probably fare worse, just given the discretionary nature of the products that they sell. But look, a lot of it will depend upon what type of recession we go into. And I think that's still it's still not to be seen. We haven't seen that yet. Now, again, I don't want to overstep my bounds of expertise. I'm not an economist, right? But I mean, it would seem to me that what's happening right now is if the Fed is working to lower inflation, okay, they're going to do that through trying to dampen consumer spending. Okay, so this would be then, by definition, a consumer-led recession. Which, again, the point I'm making is, across the board, that would, at some level, be negative for most retailers and brands.
Brands like Lululemon, or let's say Under Armour, or even like Nike, where they're more, they have a very loyal following, but at the same time they're higher priced. Do you think those brands will suffer if the economy does turn south?
Yes, I mean, I think there's a question of how long they suffer for, but then you also you've got to look at, I mean, it's how, and this is almost like a case by case type situation. I mean, how the consumer thinks of or reacts to those brands. If the economy were to slip into a true recession, and particularly one led by a slowdown in consumer spending, I think most retailers, most brands at some level would suffer.
We recently had CEOs of Saks and board members of Target and such. One of the things that really impressed me, which I was kind of surprised, not doing that type of work, is that, like, let's say this is the summer, the buyers of those companies have to think about what does the consumer want for 6 months away from now. So we're into the summer, and they're thinking about already November, December, January already. And Target just released their advance warnings that they were left with a lot of inventory left over, that they thought, I'm assuming 6 months earlier, that would sell, that now maybe with consumers going back to work or for other reasons, they're going to have to go at discounts. So one thing I'm curious of is how bad of a hurt do you think this will go to companies like Target's bottom line? And if that happened to Target, do you think that's also the same for other retailers like Walmart, Costco, others like that?
Well, look, it's a very interesting question. Okay, so I'll say a few things that might contradict with one another. I think retail has become a much better run business, over the last decade, several years, let's say that. Okay, and these companies across the board they have they have a lot more digital, technological digital tools at their disposal. Okay, so that allows them to manage inventory, to forecast demand better than they had historically, because that really limits the risk. Now, you mentioned some names there. I don't necessarily follow the department stores like a Saks or a Nordstrom. But companies like that would be more susceptible to the dynamic you're describing, because they are purchasing seasonal product relatively far in advance. Okay, but a lot of other companies, like names within my coverage universe, I'll look at like the home improvement retailers, Home Depot and Lowe's, or a company like Tractor Supply. Sure, there's a little bit of seasonal product there, okay, but they don't inherently have the risks that seasonal risk or that fashion risk that some of these clothing retailers would have. Okay, so there's not as much risk to them making these forward type purchases. As these retailers have become much larger, much more dominant, they've got more leverage over their supply chain. Okay, so they still have to work to manage inventories, but in times of volatility, they can pass that pain, if you will, back to their suppliers, just to a certain extent. So that really helps to cushion any impact of inventory issues upon their businesses. So the net is, yes, it could be an issue, and you're right. We are seeing this, these inventory overages in companies like Target. Now, a lot of that was simply that a company like Target, and we've heard something similar from Walmart, and even frankly something similar from Amazon, that they anticipated that the pandemic dynamics would persist longer than they actually did. Okay, and so now they're stuck with too much of the wrong inventory.
Do you think by having to discount so much that will be hurting their next quarter, which will be going into the third quarter and into the fourth quarter of this year?
That's typically the trend. And again, we have to see how this plays out. I think Target may have said something to that effect already. Mm-hmm. But usually, and this has been another trend with these retailers, is that when they do have an inventory problem, they work to correct it as quickly as possible, because an inventory problem usually does not correct itself, right? So they've kind of take the idea that let's correct this as soon as possible and move on.
Commodities such as, I think, like lumber. At one time, about 6 or 8 months ago, lumber was going up like gasoline is today, daily. Every day, the price of lumber was going higher and higher. But now it looks like lumber and other types of commodities may be going down a little bit. I'm just thinking of lumber. Will something like that help a retail company outlet like a Lowe's or a Home Depot, for their margins will be better? Or does it really not make a difference that they just pass on the price to the customer?
Well, so in the case of lumber, that's typically a pass along. Mm-hmm. Okay, so what happens with, I'll just say Home Depot to make it simple, right? As lumber prices climb, Home Depot will raise, their retail prices of lumber in tandem with that. So, so essentially becomes, like I was saying, making the point before, a sales driver. You're selling maybe the same number of lumber units, but at a higher price point. So that becomes a sales driver. So, that simple math would imply the margin, basically holds in. But what we do see happen, and in the case of lumber, it takes a while, but you do get to that point where you actually have demand destruction. And I think you're referring to the cycle we had just several months ago where lumber prices spiked significantly higher. You actually saw weaker demand then for lumber. At the point, where a home builder, it actually, in some cases became prohibitively expensive to build a home, or in certain remodeling projects where, people either delayed or canceled the remodeling projects because of the cost of lumber. But I would say generally it's a pass along, and it's a relatively successful pass along, but you do reach that point where you actually get demand destruction.
Do you think companies like Home Depot and Lowe's, now that people are leaving their homes that they were cooped up in for 12 to 18 months, and now they're going back to work, do you think those kind of home improvement companies will still see strong growth? Because if I'm remember correctly, and correct me if I'm wrong, I think, didn't you have a price target of, I think, $470 for Home Depot. And that was a while back. So do you still have a 470 price target on it? And about the thought of Home Depot and Lowe's still being strong to consumers?
Look, it's a great question, okay, and something we're watching very close. I would say this is the dynamic we see right now. So yes, I mean the economy's open, okay, and as a result of that, you're seeing people go back, to their offices. But and again, I actually have fun anecdotally having this conversation with family and friends across the country. To what extent they're going back to the office. I mean, what I'm hearing a lot of is that yes, people are going back to the office, but they're going to the office far less than they had been going to the office pre-pandemic. So net, they're still spending more time in their homes than they had pre-pandemic. So look, it's not the 2020, when people were spending all their time in their homes, but they're spending more time in their homes than they had historically. And I think as a result of that, this is in continuing to recommend Home Depot and Lowe's. This is one of the sort of the bets we're making, is that there has been a dynamic shift here. They're looking at their homes, they're spending more time in their homes, they're more they remain more focused on that home, even as the pandemic has subsided. I think in the back of people's minds too, maybe even, they're spending more time in those homes. They know now that we've been through this. Okay, there's always that chance, and hopefully it doesn't happen, but there's always that chance that we'll be back in some type of situation where we're spending more time in our homes. Look, sales growth for Home Depot and Lowe's has slowed. It's slowed to levels that are still very healthy, suggesting a rebasing higher in those businesses. But I think the dynamic there has changed.
If you think both of them, let's say, will slow down because of the dynamics of people going back to work and such, and let's say you had X amount of dollars and you had to choose between buying stock in Lowe's or buying stock in Home Depot, which one would you choose?
Yeah, I've said this for a while, and I laugh because I've had this conversation so many times. Look, I think Lowe's is the more attractive bet here, and it's really two reasons. I mean, one, you still have more what I call profitability slack. I mean, Lowe's now under a new management team. I think a very good management team.
Which I think, if I'm not mistaken, he's the former CEO, or he's a former executive at Home Depot, isn't he?
That's exactly right. So we have Marvin Ellison, who's now CEO of Lowe's.
That's it, yeah.
Previously run stores at Home Depot. He's been around the home improvement business for most of his career. And I think Marvin's doing just a fantastic job at Lowe's. So the point I'm making there is you still have this, what I call this profitability slack. Lowe's is still less profitable for operating margins than Home Depot. I think they're working towards those operating margins at Home Depot. The other point, look, Lowe's is a cheaper stock. So you've got an extra kicker, if you will, in earnings growth because of the still depressed operating margins, and you've got a lower multiple. So I think Lowe's is the more attractive stock. Now, for as long as I've said this, okay, and I'm also a big fan of Home Depot, the stocks tend to move together. They really do. I mean, it's interesting over any length of time. These stocks tend to move together. So I think I always tell the clients, maybe we not overthink this, right? But I do think I think at the margin, the Lowe's is the better bet here.
If you're just joining us right now, we're talking with Brian Nagel. Happy to have him. He is the senior analyst at Oppenheimer. Don't go away. We'll be right back. We're talking with Brian Nagel. Brian is the senior analyst of retail at Oppenheimer. So happy to have him. Brian, before leaving, we were talking about Home Depot, Lowe's, and other such like that. I'm curious also about warehousing. It was just recently, during the pandemic, companies like Amazon and Wayfair and FedEx, others were on a tear of renting out warehouse space. Now, all of a sudden, they're subleasing it because I think they've either found that they've leased either too much or maybe business has slowed some. Is this a bellwether of something to come when retailers such as Amazon or other online liners are wanting to sublease?
Look, the pandemic persisted for a lot longer than most people envisioned. Okay, I think that's a fair statement, right? Mm-hmm. And what happened with these companies, and I think the market in general, is that we started to look at these trends. Whether they be, like we were talking about the outside spending at home or other categories, or this rather significant incremental shift to online spending. And I think that, these companies in the market start to take these as no longer, transitory, but instead permanent in nature. Okay, so as the economy has reopened, one piece of the normalization that we've seen is consumers have returned to stores. Now, look, let's be honest. I mean, e-commerce is here to stay. Most of the companies I cover, kind of now blend together physical shopping as well as online shopping. But that outsized, that really incremental growth in e-commerce sales has slowed. And I think that's where you're starting to see some indications now of maybe excess capacity in warehouses. Most of them are still over time looking to build out more warehouse space because they, again, over any length of time, I think it's very fair to say that e-commerce sales growth will continue to outpace retail sales growth in general.
When you have a company such as Amazon, they've got different compartments at Amazon. You've got the retail outlet that sells products, and you've also got the AWS, their web services. Well, right now, their web services is their cash cow, and bringing up the rear is the retail services. But do you think that, just as what you just said, do you think that there will be, the retail outlet portion is growing, that it will maybe overtake the AWS of Amazon?
From my vantage point, what I do is I watch Amazon very closely as a competitor to a number of the retailers I do cover, right? Okay. And I'll say this, and I think this is another topic I've mentioned a lot over the last few years or so, is that there was a period not that long ago where Amazon and in the incredible retail business model of Amazon, really had a lot of these high quality legacy type retailers and brands deer in the headlights. They just did not know how to compete effectively with an Amazon. Okay, and then this is when you had, this is several years ago now, but there was a lot of chatter about Amazon's basically going to take over the retail world. What's happened, and I think this is absolutely fascinating, is that you look at companies like, and again, it could be any number of companies like a Best Buy, Dick's Sporting Goods, to a certain extent, the home improvement retailers, whatever. All these companies, all these traditional retailers really worked aggressively to build out their own online capabilities. Whether they're websites, their ability to fulfill orders, all these aspects. And today, while Amazon is still Amazon, okay, and Amazon's a force to contend with, I think it will always remain a force to contend with. I would say most of these other traditional retailers now are competing extraordinarily well with Amazon. And when I make this point, I use Best Buy as one of my favorites. Is that if I'm a consumer looking to make a consumer electronics purchase online, I think the experience on Best Buy is better. I mean, is at least as good, if not better, than that of Amazon. Best Buy's really figured this out. So it's Amazon's just not that let's say deer in the headlights type threat to traditional retailers that the company once was.
So brick and mortar is not going to go away. It may be reduced as far as percentage-wise, but with online. But brick and mortar will be here to stay for the foreseeable future.
Absolutely. Absolutely. And look, I think what's happening, so there's been a washout, and I don't know the specific number, but look, you've had a number of retail stores close over the last several years, right? A number of lower quality malls close. Okay, so there's been this washout. But again, now is the retail sector, consumer sector has emerged even stronger. What you're really seeing happen now is that these companies have rethought their stores. And really how does operating stores effectively allow them to compete much better with online-only operations? And then interestingly, so I cover Wayfair, which is traditionally an online-only seller of home furnishings, right? They've dabbled, and I think over time Wayfair will operate stores, because they're realizing, even though they came purely from an online model, there's a significant benefit in serving customers by having stores. That physical touch point. So to answer your question, look, the retail store is very much here to stay. I don't see it going away. In fact, in run better, I think the value of a retail store is now higher than it's ever been.
When you have a company such as, let's say, a Target, or I'm thinking of Walmart specifically, they've grown more in food, purchasing of food inside Walmart, and now their food department is greater than, say, many, if not all, like of the major brands of Kroger or other type of national food outlets, and only growing. Is the margin of food that good for a company like Walmart, or is it to get people in so they can get a higher margin for people to purchase other items?
Well, I've got a colleague that follows Walmart and really what follows Walmart from the perspective of food. So I rely on what he's taught me essentially. And look, I would say, if he was doing this interview, he would say, look, food is largely, it's a traffic drop. It opens a company like Walmart up to a much larger potential, much larger base of target customers. But because you're right on generally speaking on the margin profile. But look at my retailers, I've seen that same dynamic. There are these items which carry with them a high frequency, a very broad consumer base that are generally lower margin. And why a retailer will attack that is a traffic driver. It builds frequency to their stores or to those websites.
I see. Brian, unfortunately, the clock doesn't stop. I hope you come back. I had a great time.
Absolutely. Nice conversation. I appreciate you having me on. Thank you.
Thanks so much. Brian Nagel, he is the Managing Director and Senior Analyst at Oppenheimer. Thanks a lot, Brian. Appreciate it. Well, if you've got a question about finance or a comment about the show, we would love to hear from you. Make it pithy, make it concise, and write us at andre@wallstreetwrapup.info. Now for a look ahead for the market information for next week. But first, on this day, June 24th, 1971, this entrepreneur founded what company with a goal to deliver packages overnight no matter where it originated? Who was it and what was the company? We'll have the answer in just a moment. Well, on this day in 1971, this entrepreneur founded what company with a goal to deliver packages overnight, no matter where it originated? Who was it and what was the company? Fred Smith was his name, and the idea, according to his Yale business professor, was, he said it was so daffy that he almost flunked him for even proposing it. Well, he named the company Federal Express. And Federal Express is 51 years old today. Just goes to show just that if they laugh at your harebrained ideas, anything may be possible. You may have the last laugh. Well, here's a question. Is your retirement account with Wisdom Tree Mutual Funds? Well, next week, we'll be talking with the Chief Investment Officer at Wisdom Tree, Jeremy Schwartz. Jeremy oversees the asset management company with over $30 billion of assets under management. Is your 401k down? Are we headed into a recession? Well, if so, you will not want to miss next week where we have Wisdom Tree's Jeremy Schwartz right here on Wall Street Wrap Up. And we want to give a big thanks to Jeff Kurth for helping me out this week. Jeff, appreciate it. Could not have done it without you. Thank you, Jeff. And as a reminder, we repeat the show on Sunday mornings, but the best way is to set your DVR so you'll never miss an episode. And that's our show for this Friday, June the 24th, 2022. Hope you've enjoyed it. My thanks to Brian Nagel from Oppenheimer & Company for joining us this evening. But as always, it's you. We appreciate you for allowing us into your homes tonight. Remember, follow us on all the social media on Facebook, now known as Meta platforms, YouTube, Twitter, and WYES.org. So have a great weekend ahead and a productive week as well. I'll see you next week. For Wall Street Wrap Up, I'm Andre Laborde. Remember, money never sleeps. Good night.
Sponsored by New Orleans Distillers, creators of fine spirits and liqueurs. Through dedication to science, art, and passion, blends of tradition and flavor emerge. For you, always locally crafted. New Orleans Distillers, classically Southern.